Okay, peeps, welcome back. So today we're going to be getting deep into the macroeconomics and into possible recessionary scenarios and my personal forecast for the outlook of things for the rest of 2024 going into 2025. So with that being said, let's get it. Okay, so the markets were down quite a bit today. Um, as you guys can see here, pretty much red as far as the eye can see. Okay, everything was red. The grayscale trusts were red. Native crypto was red. As you guys can see, Bitcoin had, well, you can't see it now because it's green, but Bitcoin's down to 61,000, ETH less than 3,000. A lot of the altcoins have been getting absolutely smashed too. And you can see that the indices here are down quite a bit today. Again, this is because of the job numbers. I'm going to get into that in a minute. So Nasdaq down 2.5, the S&P down 2%. I'm not sure why oil's dropping. I have no idea. So Russell 3.6% pullback. Dow Jones still holding up pretty well, 1.5%. So it's looking pretty ugly. Okay, not gonna lie. I mean, I can go over the individual positions, but a lot of those have fallen pretty substantially. So we're not going to get too deep into that here. This is kind of a bigger picture view. Okay, so let's start with the job numbers. So pretty much the synopsis of what's going on here is that the actual job numbers that were posted were lower than expectations, and the unemployment rate did rise again. Okay, I've told you guys before we were keeping a close eye on the unemployment rate. It is a little bit concerning. What I will say about the employment market is if you are in the market working as an employee, the best possible position you could put yourself into is, in my opinion, one of two positions. Okay, number one, putting yourself into some level of employment or job that is recession proof. Okay, that could be things like warehousing. It could be things like, I mean, of course, even that's not a guarantee. It depends on what kind of warehousing we're talking about here. If it's like food, then food and drink, that's probably mostly recession proof. Or so some kind of job that would be, if you understand economics, that would be considered, and economics and demand, that would be considered recession proof. Again, some of that you're going to have to do your own research on. I could do a whole hour on just that, but we don't have the time here. So the second thing is to make sure that you have, if you don't have them, to be able to build multiple different skill sets, and also have multiple different sources of revenue, okay, or income. As you guys know, the average person only has one source of income. We have six. So there's that. And also, the other thing is to make sure that, again, not financial advice, but it's always a good idea to have at least some cash on hand, some kind of emergency fund, preferably. In our measure of emergency fund is generally at a minimum 6 to 12 months of cash and or cash equivalents. Again, unless you're, a bazillionaire and you have endless money and endless income, then, the average everyday person, even in the middle class, have to worry about these things. And also some, maybe lines of credit cards that are not being used, that are just sitting there waiting to be used, in case they're ever needed. So that's all I can say about that. Like, personally, I will tell you guys that I do have multiple skill sets. Okay, I do also track the tech sector, just so y'all know. There's been multiple layoffs for that, which saves the companies a lot of money. I'll get into that in a minute. But I am able to code in Java and JavaScript. Okay, I do know how to code. I'm a musician. A lot of you guys don't know that about me. I am able to sing. Okay, I do play piano, guitar, stuff like that. I can also teach it. I do kickboxing. I'm an archer. I am a day trader, swing trader, investor. I work as an employee, as you guys know that. We do content creation here on this channel. So a lot of different skill sets. Okay, so I'm. You guys have not seen it, but at some point in the future, you probably will. The living proof of one person being able to create multiple skill sets, and also having a lot of different experience in different job markets. Okay, so anyways, enough about that. So let's take a look at the job numbers here. The pretty much the short of it is that the actual numbers were 114,000 jobs created, and the expectation was 175,000. So that's a massive difference from expectations. So the markets didn't like it, and they decided to sell off. Okay, that's pretty much that. Now, do I think it's the end for tech, and tech is going to go down? No, I do not. Again, I've looked pretty heavily into the tech earnings. The ones that have had misses have been very slight misses, and they've made up for it in other areas. So, not really shocked. In my opinion, I think with the NVIDIA earnings coming up, NVIDIA is going to pump the entire tech market to the moon. As you guys can see, NVIDIA has not missed earnings in a very long time. So that's on August 28th, as you guys can see, towards the end of the month. So the last time they missed earnings was at the bear market low. And again, it was a very, very small miss, barely missed on earnings. I was green on everything else pretty much every other single time. So again, in my opinion, NVIDIA is going to pump the tech sector up at the time of earnings. So the thing I want to say about the tech companies, okay, the markets have been, and I'll show you guys this here, okay? So the markets have been selling off massively, especially in the tech sector. You guys can see that basically in the NASDAQ, the sell-off has been huge here, okay? So from the peak to the bottom, 12% on the NASDAQ. Take a look at something like the S&P. S&P hasn't really moved that much, okay? It's roughly about half the NASDAQ. What does that tell me? That tells me that tech is the one that's getting sold off the most. Now, there was some kind of hurricane in Texas, and there is also talks of, okay, so you have 9% on the Russell, but again, the Russell's not even at all-time highs. The all-time high is 2,400. So you have some talks about regulation on big tech. Look, I can tell you guys right now, that's not going to happen, okay? If there's anything that's going to happen in big tech, it's basically going to be to ensure that people's First Amendment rights are not being infringed upon with, how do I say it? Censorship. That's the word I'm trying to think of. Okay. That's probably going to be the extent of it. I don't think it's going to be anything above and beyond that. I don't think Congress really cares. You guys got to understand the members of Congress, a lot of them are actually buying and or trading these same exact tech companies. Okay. Like Nancy Pelosi and NVIDIA. I don't think I need to say more about that. So let's get into some other stuff here. So, all right. So the Fed potentially is getting ready to cut rates in September. What does this mean for money sitting on the sidelines? Well, money on the sidelines, assuming the prices are cheap enough at the time, are going to want to flow out of money markets and money market equivalents and bonds back into risk on assets. Why? Because when the Fed cuts rates, the interest payments on money market savings accounts and bonds will go down. And these people that have all this money, they're going to want to make money. So where are they going to put their money? They're going to put their money in the place where it makes them the most money. So the markets will essentially inverse. The bond and savings market will flip. That market will go bearish. The risk on markets like stocks and crypto will go bullish. Okay, the prices will go up because when the money flows, look, cash gets eaten away by inflation. Okay, that's just the way it's designed. It's designed to go down in value over time. But people that invest in risk on assets like real estate, crypto, stocks, bonds, stuff like that, well, bonds is risk off, but you know what I mean. They generally go up over time. Okay, so inflation benefits those that buy risk on assets. So this is at an all-time high. I expect it to drop, kind of like you can see back here in 2008. It went from an all-time high to what? It dropped off a cliff. And where do you guys think that money went from? I should say from the dot-com bust and also the GFC. It went back into risk on assets. Okay, that's exactly what I'm expecting to happen. So the other thing I want to talk about here is there's some macro bullish, bearish indicators going on. It's kind of a mix. It's hard to say exactly what to expect here. Okay. But the GDP is positive. Okay. It's been positive essentially flawlessly, except for right around the back half of 2022. Again, that was right around the bear market lows. And it's only been negative once. Okay. It's literally only been negative once since the pandemic. I see that as bullish. That tells me the economy still has strength. Now, in terms of the market's expectation of Fed rate cuts, so you're looking at potentially in September anywhere from 1 to 2 rate cuts. And then in November, we're looking at roughly about, and keep in mind, this thing changes every day, every week. So November, 2 to 3 rate cuts. And then December, you're looking at potentially even as much as 4 rate cuts. And it keeps dropping as time goes on, okay? Here's what I'm expecting the Fed to do. I'll tell you guys first what I expected the Fed to do earlier in the year. It was it was my expectation that the Fed was going to start cutting rates in March of 2024. Okay, March, April, somewhere in there. Start of Q1, end of Q2 didn't happen for whatever reason. I don't know. I expected the Fed to kind of front run basically the sahm rule, which we'll get in a minute. But they didn't do that. So because of the fact that, in my opinion, they've waited a little bit too long, and again, I don't think it's necessarily too late, as it were. I just think that if they're going to cut, they need to do so now in September. For the potential of a soft landing. I do think that the Fed likely is going to have a 50 basis point cut in September. They might even have a 75 basis point cut. You guys got to think about this. When they started raising rates, they began with a 75 basis point hike. Okay. And then they reversed it down from 75 to 50 to 25 to 0, where they had like a hike and a pause or something like that. So we may see something similar. Okay. We may see, 75 basis point cut, 75 basis point cut, and then, 50, 25, 25 and a skip, 25 and a skip, whatever. We may see something exactly like that, or we might just see like, 50, 20, or 50, 50, 25, 25, 25, 25, 25 and a skip, 25 and a skip. It depends on whether the market really actually truly needs the rates cuts or not. In my opinion, they do. I think the time to cut is now. I think the Fed needs to stop BSing and get to the point. So with that being said, let's get into the sahm rule. And again, I do think they will do emergency cuts, but I don't think it's necessarily emergency cuts. I think they're going to portray it as that, but I think that the Fed still has more time, in my opinion, before things get too dire. But like I said, the time for the Fed to act is now, not later. Okay, now as in September. September, in my opinion, is still too far away, but it's still early, according to the amount of time I think they have. It's still early. So the sahm rule. All right, so this indicator has predicted every recession. Well, not quite every recession, but almost every single recession throughout history once it gets past a 50. Okay, so you can see it pretty much hit a 50 pretty much right at the start of the GFC, and then of course recession, right? And then this thing just skyrocketed. So we're at a 50 now. 50 back here during the dot-com bust, 50 during the 1990s. I mean, I can go on and on and on about this. This thing's been pretty accurate for the most part. It can go up and not necessarily go past the point and not cause a recession. Again, this is just one major indicator. I do take this one pretty seriously. Personally, look, this is the reason why we're trying to get our cash position up, because, the way that we see things is whether it's a bull market or a bear market, it doesn't matter whether it's QE or QT, it doesn't matter. We always have some kind of cash and cash equivalents on hand. We've been doing it this way since 2017, 2016, 2015. Okay. It doesn't matter if times are good or times are bad. We always prepare for as if times are bad. I know it sounds crazy, but it's better to be prepared than to be, like some of these people out here just maxing out their credit cards with $1,000 a month car payments and stuff like that. And next thing you know, they get laid off or something like that. We always live below our means. I don't ever want to be in a position like that. So I'll just say that about that. So there's that. In terms of the immediate short term, I am expecting the market to have a bounce either next week or maybe the following week. Again, it may take a little bit longer than that. I don't know. But you guys can see the fear and greed here is in fear. We're almost at the tipping point of extreme fear. Usually when the markets rebound to the upside or pull back is usually when we get the extreme one way or another. Okay, you can see this as a reverse indicator. If we're in extreme greed, there might be a pullback to the downside. If we're extreme fear, there might be a rip to the upside. So a lot of these metrics, as you guys can see here, are more closer to fear than they are not. What that tells me is we're getting close to a reversal of some kind. So in terms of the positions that we have in the yield max ETFs, look, I'll just say this about the yield max ETFs, okay? First thing is they're designed for income, okay? They're not necessarily designed for appreciation, but you guys got to understand when the stocks really rip to the moon, these things also, not always, but a lot of times they really do rip to the moon, okay? Are they going to go zero? Probably not. They'll probably just do like a stock split like Tesla had. You guys got to remember something about the markets. Okay, the markets generally over time go up more than they go down. The Fed usually serves as a buyer of assets in the markets during their QE cycle, which, in my opinion, they're heading to. Um, so on the all-time time frame, we are down the largest we've ever been. But again, you guys got to understand, there's going to be ups and downs in the markets. There are corrections; those are normal in bull market years. In terms of, and once again, I'll say it again, I can't put the numbers up here because Robinhood doesn't calculate it, but we're actually up roughly about 25 to 30% on our portfolio, including profits, options, premiums, dividends, and also the general average or the general value of the portfolio based on current prices. Okay, so we're actually, this says negative 10, but it's actually positive 20 or thereabouts. And even with that being said, we are still making quite a bit every month. Okay, we make between $6,000 to $7,000 a month of passive income and or other forms of income outside of the job. Not too worried about that. We have multiple different financial accounts. We have multiple different sources of income, multiple different skill sets. I can go on and on about this. We're not concerned about the market pullback. It kind of is what it is. But I do think it's a good idea, in my opinion, to have some cash on the side or a lot of cash on the side for situations like this. There are people like Warren Buffett who literally just keep cash on the side and build up their cash position for the exact, doomsday scenario, so to speak, to buy at the absolute dirt cheap prices. Some people do that. We don't necessarily do that, but we just kind of adjust over time. So, my opinion, the sell-off in the NASDAQ is pretty overblown. I mean, again, you guys got to understand from the technicals, we were in overbought territory for quite some time. So we're getting pretty close to oversold on the daily. Again, the NASDAQ is down 12%. Do I think it goes down to the 200-week moving average, which is this white line here? Again, this white line, generally speaking, I actually got to go over here to the weekly time frame to show you guys this. But do I think it goes all the way down to the weekly target of 14,400 on the NASDAQ? No, I do not. Okay, I'm going to tell you why. A couple of reasons. Number one, big tech is the safest, most well-funded, most well-capitalized companies in the world. Okay, they have hundreds of billions of dollars or trillions of dollars. Like Apple has 300 billion in cash. I'm not worried about what's going to happen with them. Okay, so you guys can see here, there's a reason why we have the vast majority of the money we have in Robinhood invested in the Magnificent Seven companies. There's a reason for that. Okay, they are the most heavily funded, for the most part, most essentially recession-proof companies. Okay, other than something like McDonald's, for example, because of the fact that they have so much cash and so much pricing power. There's a reason why we invest the way we do. So 30% drop here is what the potential could be. Do I think that's going to happen? No, I do not. I think worst case scenario, we get maybe, I do expect a bounce in the immediate short term. We might even get one as soon as next week because you can see we are at this trend line. Every time we got close to this, we did get a bounce. Worst case scenario, we come and retest the 2021 highs, so 16,000 to roughly about 17,000. Again, that's a massive wall of buyers right there, okay, and or previous sellers. This is a multi-year level now of support because we flipped it. So, and the same thing is true for the SPX. So worst case scenario, maybe 20, 23%, and then it's over, okay? I don't think even if we do have a bear market, it's going to be as bad as people say. Of course, it kind of depends on how fast the Fed moves and what they do. Same thing with the SPX. You guys can see we're just outside of the channel. So what we're looking for once again here is some kind of breakout. We might even get this exactly as we got it before, 3 weeks down, and then a big rip to the upside. You guys got to understand, I mean, between the last bottom and the current top, we were already up basically double what we're down now. So from the last major pullback we had back in July of last year, and in my opinion, that is the last major one we had, we're up 37% on the S&P, so 6% down. Is that a big deal? Not really. So worst case scenario, once again, for the SPX, 2021 bull market highs would be the major stopping point, the support zone for the SPX, minus 18%, worst case scenario, okay? And again, if that does happen, it's not going to happen all at once. It will happen probably in, moves. Like we'll have a move down and then a bounce and then a move down and a bounce, or what's known as a bear market rally or a suckers rally, until we eventually get down to the zone and then boom, pop up and then just start ripping to the moon. It may not even go that low. I don't know. But another reason why I think the markets are going to bounce in the more immediate short term is because this move is much more aggressive than what we saw back in July of last year. Okay. So I want to point this out to you guys on the NASDAQ. So on the NASDAQ last year, from the highs to the lows, you can see it was a 98-day period. Okay. 98 days of selling. And we went down roughly about 12%, pretty much almost exactly the equivalent of what we're currently seeing. Okay. Almost exactly. But it was over 90 days. So in this particular scenario, it literally just happened in 4 weeks. That's it. 4 weeks. Okay. 21 days, 12%. So I think the market's actually getting ahead of itself. That's why I'm expecting aggressive rallies to the upside at the very least, because again, 90 days in this pullback, only 28 days in this one. The market's just massively overextended to the downside. I don't think it's going to continue for much longer. That's just my opinion. Now, going into 2024, I will still stand by my prediction that I think the S&P, and I do think Tom Lee is going to be right. Okay. Yeah, sure, there's a risk of recession. We'll go a little bit more into that, but I do think Tom Lee is potentially going to be right here at 5,800. I'm going to say somewhere between 58 to 6,000, okay, on the S&P. Now, the other concerning thing is that the yield curve is about to uninvert. So we're 9 percentage points away from uninverting the 210. That's the one that we use. As you guys know, the Fed probably, if I'm not mistaken, I believe they use the 310. Does it necessarily mean the markets have to drop? Well, not really. I mean, we saw it uninvert before. And well, I would actually have to go over this. Let me see if I can actually pull this up. So let's see, US 02Y / US 10Y. Okay, so here's what it looks like. You guys can see we're 2 percentage points away from uninverting. So the last time we got an uninversion was in, you guys can see we were inverted here, okay, and we got an uninversion here. You guys got to understand the bear market was already well underway in 2022 before this thing even became inverted on the 210 year, okay, and then we got uninverted, and what happened? It went up more and the markets went down, which makes zero sense. Okay. Generally speaking, when this thing uninverts, that's when the markets go down. I'll basically refer back to what I said before, which is that the 2022 bear market was not supposed to happen, in my opinion. When the Fed raises rates, the market's supposed to go up, not down. In this case, the Fed raised rates and the markets went down. So what am I expecting this time? The Fed cuts rates and the markets will go up. Doesn't mean we can't have a 10 to 20% pullback. But in my opinion, by the end of the year, likely the markets are going to go up. So the other thing I will say about the Fed, okay, there's a few things. I suppose it is true that the Fed can't necessarily be fired, okay, because they're an independent agency, but you guys have to understand once every 4 years, if a new president is elected, they can elect a new Fed chairman. Okay, so Jay Powell's job is at risk if he does something that Trump doesn't like and Trump gets elected. But even on the flip side, Biden did come out, and you guys can look this up for yourself. He did come out and say that there was going to be a rate cut this year. Usually the president doesn't talk about stuff like that, but I did see it on the news. So either way, the cuts are coming this year. Okay. Biden is the current sitting president, said there was going to be a cut. Trump, you already know he loves basically tax cuts and all that stuff. So there's going to be cuts from his end. So either way, Jay Powell and his buddies, they're going to have to cut rates, whether they like it or not. And I think it's probably coming in September. So in terms of crypto, let me talk about crypto real quick. I'm not going to go too deep into this, but I think I do still think that we're on track to hit new all-time highs by the end of the year. It does not look like it now. That's true. It's possible we could come down to any of these support zones, even this trend line here, all the way at 38, 40,000, and then rip to new all-time highs next year. That's possible. I've told you guys this is a possibility. Okay. So we get a breakdown to this trend line. That's the bearish case scenario. This bull flag is the bullish case scenario, which you guys know if we get a breakout of that, it's 125K for the target. So anything can happen between now and the time Bitcoin is supposed to go up. In my opinion, end of year, Bitcoin is still poised to break new all-time highs. Anything could happen between now and then. We could get a 40% drop. We could get a 100% rip. I don't think anything changes with crypto and Bitcoin, okay? And for the altcoins, the reason why we're buying the ones that nobody talks about is because the ones that people are already talking about right now, they're probably going to be oversaturated sooner rather than later. And eventually the ones that nobody are talking about are going to be the ones that moonshot, in my opinion. And we want to get in before people are talking about those, okay? Things like Filecoin, Scale, stuff like that, deadbeat coins that nobody's looking at. It's not the hot crypto of the week, whatever. So by the time, by the time people are talking about this and it becomes like everybody's favorite token, we've already bought all the way down at the bottom. Okay. So that's kind of the expectations for the markets as a whole, my personal predictions by the end of this year. So anyways, hope you all enjoyed this content. Please like, comment, and subscribe, and I'll see y'all later. Peace.